Okay, good evening and welcome back everyone to our intermediate options course. Today we're going to be talking about strategies specifically around selecting optimal expiration dates and strike prices. And we're utilizing this time to discuss more of a broader picture in terms of understanding how to utilize options, because whenever we look at, there's lots of different option strategies that you can trade, whether you are relatively new and you're selling cover calls and cash secured puts, or you're an experienced trader and you're trading spreads. Regardless of what strategy we're trading, we have to select expiration dates and strike prices for all of those strategies. So today what we want to do is we want to discuss some of the themes around how do you go about selecting the right expiration date for your strategy. So we're going to start off with more of an overarching understanding as to how do you select the best expiration dates and strike prices for your strategy. And then what we'll do is we'll dive into each individual strategy and then take a look at how to go about selecting specific expiration dates and strike prices for specific types of strategies. So those are the things we're going to go over here today. Now, before I get started, just a quick disclaimer. What we're going to discuss here today is purely for educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, for those of you that are first-time users of OptionsPlay, you can sign up using this link here on your screen. We're going to be using this platform to help you give you a better understanding as to how to navigate the options world. And the reason that we created this is because most of you use a page that looks similar to this, where you have a listing of all the different strike prices and expiration dates on a page that looks like this, and you have to select on a page like this which expiration date. So for example, in June, and you have to select a strike price. You can select calls and puts, and you can select combinations of calls and puts to achieve the risk profile or the market outlook that you have on that underlying stock or ETF. Now, when you're using this type of page, it's a very manual process to think about which expiration date suits your time horizon, what strike price suits your outlook, if you will, on the underlying stock, whether you're bullish or bearish, how bullish or bearish determines your strike price. So there's a lot of factors that go into determining how do you select your starting point. And that's part of why we created OptionsPlay, was to help you select expiration dates and strike prices. But today what we want to do is we want to show you why we select certain expiration dates and strike prices so that you can understand why we're doing it. You can have a better understanding so that when you're using pages like this, you know where to go, where to start, or you know what is an optimal starting point. You can always start from there. But that's really the goal here today, so that you walk away with that type of information. Now, to access our platform, it's completely free of charge, courtesy of the NASDAQ exchange. You get access to the platform, you get access to the bi-weekly options education webinars. You have a lot of resources that are coming to you to help you better understand how to trade. Now, one of the things that we are offering here is a free weekly cover call and short put report. So that's available to everyone. For those of you that are brand new to options trading, cover calls and cash secured puts are a great place to start your options trading career. So all of that is available to you using the link that I just posted into the chat window. So at this point, if everyone could please bring up your chat window, which is at the bottom of your screen, and just please type yes into the chat window if you can hear me loud and clear, just so I know that the chat window is working. Okay, perfect. I see a bunch of yeses. Great. So today what we're going to do is we're going to cover optimal expiration dates and strike prices. We're going to start off by talking about expiration dates. And to learn about expiration dates, what we're really concerned about predominantly is going to be time decay. When we're looking at time decay, that's really one of the things that's either working in our favor or working against us whenever we're buying or selling an option. So we want to talk about where on the expiration curve do you want to buy options? Where on the expiration curve do you want to sell options to maximize time decay working in your favor? Then we'll talk about strike prices. When we talk about strike prices, we also have to factor into time decay. But there are some other things that we now have to think about when we're thinking about strike prices beyond just time decay. Generally speaking, when we're talking about expiration dates, we're predominantly just concerned about time decay. But when we talk about strike prices, we're also concerned about direction. We can also talk a little bit about leverage or gamma. And then what we'll do is we'll talk about the different strategies, how to utilize what we just learned on expiration dates and strike prices and how they apply to specific strategies. So this is part 2 of our intermediate options trading course. And part 1, we covered trading psychology. We talked a little bit about the mindset that traders need to have in order to focus on minimizing losses in your portfolio. Today, we're talking about optimal expiration dates and strike prices. So the next event that we're going to have is more of a live market outlook with Q&A. This is really where we're going to wrap what we've learned in part 1 and part 2 in some live market analysis, where we're going to take a look at the markets together. We're going to look at where the current markets are trading, how we can apply the things that we've learned to some specific option strategies using options play, using some of the charts. So I hope that you guys are able to join us here on June 10th for our next market outlook. So let's first off and start talking about expiration dates. So what I have here on my screen is a simple graph, and what it shows you is the price of an option as it approaches expiration. So as you can see, the curve here, whoops, let me use my mouse here. The curve here represents the value of an option as it approaches expiration. And one of the things you're going to notice is that as it approaches expiration, what happens? The value of an option starts to erode, right? This is what we call time decay, or theta, for those of you that have studied some of the option Greeks. So theta is the value of the decay of the value of an option as it approaches expiration. So theta always decreases the value of an option as you approach expiration. So one of the things about theta decay is that it's not a constant measure, meaning it's not like you lose a certain amount of money every single day and that amount stays constant. What you learn, and what I have here on the bottom on the x-axis is time, on the y-axis I have the value of the option. So what you learn here is that when an option still has a lot of time left to expiration, so let's just say we go out 1 year, the amount of time that it goes from 1 year to 9 months old in terms of the option's expiration, you'll notice that there's a relatively small amount of decay during those 3 months. Now, this graph is not to scale, okay? So this is a bit of an exaggerated version of what we're trying to show you, but this is more for illustrative purposes. And what happens is that for that same option to go from 9 months to 6 months, what you're going to notice is that there's going to be a little bit more decay. Now, again, this is assuming that everything else stays constant, right? In the real world, not everything else doesn't stay constant, but this is just giving you a sense for how much, when you isolate time decay, how much of an effect it has on the value of your option. And then as you get closer to expiration from 6 months to 3 months, what happens is that during those 3 months, you're going to lose a little bit more. And in the final 3 months, from 3 months to 0, that's really when you're going to lose the most to time value. So you actually many times will lose more to time value in the last 3 months as you may lose in the previous 9 months. So what this leads us to learn as far as options traders is understanding that there are 2 types of option strategies that you can do, right? You can buy an option or you can sell an option. When you buy an option, what do you want? You want to buy low and you want to sell high. So you want the value of the option to increase, right? And when you're selling an option, what do you want to do? You want to do the exact opposite. You want to sell high and then you want to buy back low, okay? Now, think about it. If you're buying an option, where do you think on this curve you want to buy? Do you want to buy somewhere down here? Do you want to buy somewhere out here? So please, you can type into your chat window, which one do you think you want to buy? Number 1 or number 2 in your chat window. So Wolfgang says number 1. And Wolfgang is correct, and a lot of you have answered 1. The reason that you want to buy 1 is because whenever you're buying an option, time decay works against you. You do not want time decay working in your favor. I'm sorry, you do not want time decay to erode the value of an option. If you buy an option like 1 month from expiration and the stock doesn't really move, you're going to lose a lot of money to time decay. You're going to lose quite a bit of money to time decay during that last month. Versus if you buy an option out here and you hold on to it for a month, you lose substantially less to time value, which means that you have a better chance that if the stock goes in your favor, that the directional move from the underlying stock offsets the time decay or the loss to time decay. So you want to minimize time decay whenever you're buying an option. So whenever you're buying an option, the general rule of thumb here is to go longer dated in your option expiration. So now this does not mean that you have to buy a 7-month option. This just means that if you're selecting from 2 option expirations, let's say you have a 1-month bullish outlook on an underlying stock. So you're thinking to yourself, I want to buy a call option, but do I buy the July option or do I buy the August option? And this part is going to be a little counterintuitive, and I'll show you in 1 second as to why. But when you're choosing between 2 expirations, you want to gravitate towards the longer dated option expiration, because if you hold it for the same period of time, the 2-month option versus the 3-month option, the 3-month option will decay less in time, so that if the directional move that you expect happens, you're going to get a substantial, you're going to get a better return on your capital, because you're going to lose less money to time value. Okay, does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. Now, on the flip side, if you were selling an option, what happens? You want to sell high, buy low. So if you were selling an option, which one would you want to choose? Number 1 or number 2, as far as an options expiration? Number 1, the longer dated options, or number 2, the shorter dated options? Wolfgang, once again, is the first to answer. Number 2, that's correct. Because when you're selling an option, guess what? Time decay is working in your favor, because the faster time decay evaporates, the faster you're gaining your income. So as an option seller, that's why option sellers tend to gravitate towards shorter ends of the spectrum. So when they're choosing between a June or July option, you're better off selling that June option, even though it has smaller amounts of premium. Now, this part, when you're looking at this on a graph like this, makes a lot of sense, right? I think it's pretty clear as to when you're buying an option, you want to buy somewhere up here. And then when you're selling an option, you want to sell somewhere down here, because on this chart, it's very clear that the evaporation of theta is much faster here than over here. However, I want to state that when you're looking at an option chain, you're deciding which options you want to trade, guess what? The selection that you have doesn't look like a chart like this. What it looks like is a page that looks like this. You have a lot of different expiration dates, different strike prices. So here's a stock. It doesn't matter what the stock really is, but it's currently trading at around 200, and let's just say 205 crowns, right? This stock is currently trading at 205 crowns. It's actually trading a little lower than that. And you have May 22nd, May 29th, June 5th, June 12th, June 19th. You have a lot of different options. You have weekly options, monthly options. You can even go further out. So there are a lot of places to choose. Now, this is the type of screen that you're actually looking at when you're selecting an option. So let's go back to that scenario, right? We want to buy. What do you want to do? You want to buy low, sell high. When you're selling, you want to sell high and you want to buy low. So this is actually, because this is the screen that you use when you're trading, this is where I find options trading many times to be very counterintuitive, right? So let's first use the buy scenario. So when we're talking about buying an option, let's say we want to buy this stock, a call option, because we think the stock's going to go higher. Now, we're taught that we want to buy low, right? So if you look at this option here, if I buy a 1-day at the money option, it costs me 1.5 crowns. Roughly 1 week option, roughly a little bit more than 4 crowns. If I go out 36 days, it's almost 9 crowns, right? So we know that we want to buy low, sell high. So when you're looking at a page that looks like this, which options are cheapest? Guess what? It's really the early options, the May options, that have the very low prices, right? 1.5 crowns, 4 crowns. As you get further out in time, they get a lot more expensive. You're paying 8 crowns, 9 crowns, 11 crowns. So this is the very counterintuitive part about options trading, is that when you're looking at a page like this, when you're buying, guess what? People tend to gravitate towards the shorter end of the spectrum because they're cheap. Who wants to buy a 9 crown option when you could buy a 4 crown option, right? That's the counterintuitive part about options trading, is that when you're selecting an option strategy to buy, you will just from a human perspective, gravitate towards shorter ends of the spectrum because they have lower premiums. And this is really the fallacy of options trading, is that when you're utilizing an option chain, you can't just think about the dollar amount you're paying. You have to think about how much time decay am I going to experience from 36 days to, let's say, 22 days versus from 22 days to 8 days. And you can actually look at this option chain to get a sense for that. So going out 15 days roughly, I'm paying about $5, about 5.5 crowns. So what that means is that in roughly 15 days, I'm going to lose roughly 5 crowns. Now, if I go from 30 days to 15 days, guess what happens? This is only about 8 crowns. So for the same 15 days, going from 30 to 15, I'm only losing 3 crowns. So if you're buying an option and you're holding on to it for 15 days, which one would you rather lose? 5 crowns of time decay or 3 crowns of time decay? The answer is obviously 3, but when you're looking at an option chain, that is significantly more expensive. And that's the challenge that I think many traders have when they're looking at an option chain, is just from a trading perspective. Trading the longer dated options when you're buying is very counterintuitive because it costs more, and you're thinking to yourself, well, I want to buy low, sell high. I certainly don't want to buy the more expensive option. But what you're going to realize is that the more expensive option has significantly less time decay. If you go even further out here, so from 45 days to 30 days, guess what? It goes from 9, almost 10, down to about 8. So you only have here roughly 2 crowns of time decay. So as you can see, the further out time you go for the same 15-day holding period, you're going to experience less time decay. So that's why whenever you're trading options, if you're buying, you want to buy the longer dated options. So here, focusing more maybe here in this particular area, versus if you're selling an option, what do you want to do? The exact opposite, right? So when you're selling an option, what do you want to do? You want to sell something that has high premium that you think is going to go lower. So this is really where, again, it's very counterintuitive, because you're thinking to yourself, okay, I want to sell a cover call on this stock. Maybe you're selling, and it doesn't matter what strike price we're selling right now, but let's say I sell a 205 strike price. You think to yourself, well, in 45 days, I can collect roughly almost 10 crowns, right? Or would I rather collect 5.5 crowns? So you ask yourself, well, 9.5, almost 10 crowns certainly sounds like a lot more than 5 crowns, right? And if I'm selling, I want to sell something that's high, that's going to erode to 0. So I certainly would rather collect 10 crowns rather than 5 crowns. Until you realize that what you're really collecting here is a total of about 10 crowns over 45 days, right? So in the example here, if I sold this June 26th option here, I'm going to collect roughly, let's just call it 10 crowns, right? But as you notice here is that if I sold the May 29th, now this was a screenshot taken a couple of weeks ago, but if I sold this May 29th for roughly 5.5 crowns, that is 15 days from expiration. This is 45 days from expiration. What you're going to realize is that what I can do is, in this 45-day span that I'm here collecting 10 crowns for, what I could have done is actually sold this option 3 times, right? Because there are 3 15 days inside of 45 day. So what happens if you sell this $5 option? If you sell this $5 option 3 times, or 5 crown option 3 times, what does that add up to? In this particular case, if I sold that May 29th option for 5 crowns, but I can do it 3 times, I'm going to collect a total of 15 crowns, right? So what would you rather do? Would you rather collect 15 crowns, or would you rather collect 10 crowns? I think the answer here is pretty clear, that when you sell a shorter dated option, on the surface, it looks like you're collecting less premium, but what you're going to find out is you can do it more often, and what that's going to do is going to add up to more premium, okay? So when we're buying an option, this is why we want to gravitate towards these longer dated options, even though on the surface they seem more expensive. And when we're selling options, we want to sell the ones with actually lower premium that seem cheaper, because we're going to be able to do it more frequently. Now, does that make sense, everyone? Please type 3 into the chat window if this makes sense to you as to why whenever you're buying options, you want to gravitate towards longer dated options. When you're selling options, you want to sell shorter dated options. Now, again, you don't necessarily have to trade on this specific time frame, right? Maybe your long-term view on a stock is 6 months out. Then you might want to trade maybe a 9-month option or a 12-month option. If your view is only, let's say, over the next 2 weeks, then you shouldn't trade a 9-month option. You should probably only trade maybe a 1.5 or 2-month option. So you have to adjust for your time frame, but whatever your time frame is, whenever you're looking at that option chain, this is the rule of thumb that you generally want to use in terms of helping you select your expiration dates. And again, many times it seems very counterintuitive as to why you want to choose these specific expiration dates. And that's part of why I wanted to provide the two different views, because the first view I think makes it very obvious. The second view, which is the view that you'd normally use, makes it actually look very counterintuitive. So I wanted to show you both. So now that we understand expirations, now let's take a look at strike prices. And this is really where, when you're looking at a strike price, just like the previous example, you can buy an in-the-money option, an at-the-money option, or an out-of-the-money option. So this is really coming down to, if you're bullish on a stock, we've discussed that, how do we select an expiration date? And now we're going to discuss how do you pick a strike price. So when you pick a strike price, there are a few other things to consider. So first of all, there's still theta. Time decay affects the different strike prices differently. So when you buy an in-the-money option, generally speaking, the in-the-money option has a lot of intrinsic value and very little extrinsic value. So you have, in this particular case, a lot of intrinsic value and very little extrinsic value. An at-the-money option is predominantly extrinsic value, and out of the money is all extrinsic value. So whenever you're selling or buying an option, what you're going to notice is that in the money options, because it's mostly intrinsic value and has very little extrinsic value, what happens is it doesn't have much time decay. The time decay actually is very close to 0, and whatever time decay it has, it generally decays almost only at the very end. Out of the money options that are all time decay will basically decay at a pretty steady and fast rate, because even if an option that's out of the money starts to become more in the money or starts to approach at the money, they're still going to be at the money. The difference between an at the money option is that once it goes in your favor, it becomes an in the money option, so that the time decay factor slows down. So what you're going to see is that you have 3 different time decay curves, because what you really want trades to do is to move from in the money to, out of the money to in the money, right? That's how you know a trade is going in your favor. If you buy an option that goes against you, what you're going to see is more of a trade that goes like this, from in the money to out of the money. And that's not what you want, right? So what you want is a trade to go in from out of the money to at the money to in the money. So when we're buying an option, again, when we're buying an option, we want it to buy low, sell high. When we're selling an option, we want to sell high, buy low. So when you're thinking about strike prices, right, you're buying an option, meaning you're buying a call option because you think the stock's going to go higher, or you're buying a put option because you think a stock's going to go lower. Where do you want to buy your options? Very similar to the first one. Would you want to buy in the money, at the money, or out of the money? Please type your answer into the chat window if you're buying an option. Would you want to buy in the money, at the money, or out of the money? Tomas says the correct answer. However, I want to clarify. So Tomas said in the money, right? So Tomas said in the money, and technically he's correct, because in the money options have the lowest amount of time decay, because time decay offsets any gains that you have in the underlying stock, right? So if the stock goes in your favor, that's profitable for you, but time decay is working against you. So whenever you're buying an option, you want to do everything you can to minimize the time decay. And to do that, buying an in the money option is many times suitable for that. But what you're going to notice here is that when you're buying an option here, when you're talking about strike prices, time decay is only one factor. There's also other factors that we need to consider. We have to consider delta. We have to consider how expensive the option is, because in the money options, while have the lowest time decay, many times they're very expensive, right? And also in the money options have what we call a high delta, meaning it gives you a very high dollar for dollar exposure to the underlying stock. So if the stock goes higher, you make a significant portion of that dollar that the stock moved higher. But if the stock moves lower, you also lose a significant portion. So what we tend to find is that you want to strike a balance between all of those things. And in order to do that, the best thing that we tend to find is that when you're buying an option, you want to buy an at the money option, because an at the money option really gets the advantage of being in the money very quickly. So if the directional move that you expect the stock to move happens, then the option will become in the money very quickly, and then you get the benefits of low time decay. And then if the trade doesn't go against you, you simply go out of the money. So that's why, generally speaking, whenever you're buying, you want to buy at the money. There's also other factors to consider that gets a little too advanced, in my opinion, for this particular course. But gamma is also another thing that's really important that when you're buying an option, because gamma is really what provides the convexity that we want when we're buying an option. We want to buy an option because we have unlimited gains if the stock goes higher. The reason that we buy an option is because we have unlimited gains to the upside if we're right, but we have cap losses to the downside. And this convexity that we're talking about here, that gives us increased leverage as we're right, but decreases leverage as we're wrong, that is best at the money options. And at the money option will increase your leverage very quickly and then decrease your leverage very quickly if you're wrong. If you're already up here, which is an at the money option, so this is the at the money option, right? If you're already up here, which is the in the money option, then you already have a high amount of leverage. But what it does when the trade goes against you, it doesn't really decrease the leverage much. And you're not really increasing your leverage much either when you're correct. So that's why when you're buying an in the money option, we tend to find that that's not the optimal place to buy. Conversely, if you buy an out of the money option, yeah, that's the in the money option, and this is the out of the money option. The problem with the out of the money options is that they're very cheap, right? And that's why many people gravitate towards buying in the money options. But even if you get the direction correct, many times you're still out of the money, so you're not increasing your leverage very much, and you continue to have a high degree of time decay, especially as you approach expiration. So those are the reasons why. Yes, in the money options give you a low time decay, but it's too expensive and it doesn't change your leverage quite fast enough. And then the out of the money options certainly are cheap, but it doesn't increase your leverage quite a bit enough. And even if you get a slight increase in leverage, you're still out of the money, and it's going to continue to have a high degree of time decay. That's why whenever you're selling, that's why when you're buying, you generally do not want to buy an out of the money option. So I know I covered a lot with you on that one slide, but it's really important to understand these concepts, but when you're thinking about selecting your expiration dates and strike prices. Now, conversely, if you're selling an option, what do you want to do? Where do you want to sell an option? An out of the money, at the money, or in the money option if you're selling an option? Anyone have an answer? That's correct. Out of the money, exactly. And the reason for it is very simple. It's the same reason why we don't want to buy an out of the money option, because out of the money options, even if the trade goes against you, is likely going to stay out of the money. And that means that time decay is going to continue working very rapidly. And when you're selling an option, you want that time decay to work rapidly. If you sell an at the money option and the trade goes against you, it quickly becomes in the money. And what happens is that time decay really slows down. And whenever you're selling an option, time decay is really the only thing that's working in your favor. You don't want to potentially slow it down. So that's why you always want to start out of the money. And what this does is it really prevents or puts in a low probability that this trade will ever become in the money, which means that you will continue to expect a fast acceleration of your income. Okay, so that's why whenever we're selling an option, and it doesn't matter whether you're selling a cover call, a cash secured put, the leg of an iron condor, whatever, whenever you're selling an option, whether it's a single leg or it's part of a broader strategy, you always want to sell out of the money options and you always want to buy at the money or slightly in the money options. Okay, so this also, in my opinion, many times is counterintuitive, right? So let's just pick one expiration date. Let's use this June options expiration, right? So I can select, so the stock's currently trading at about 205, right? So if I think the stock is going to go higher, I can buy a 200 call option, which is in the money, a 205, which is at the money, or a 210, which is out of the money. And as you can see, when we're buying, guess what? We want to buy low, sell high, right? So when you're looking at these three options, what's low? The 210s are lowest, right? $6.3 crowns versus double that. The 200 strikes are almost 12 crowns. So whenever you're buying, people tend to gravitate towards the cheaper options. They tend to gravitate towards buying the out of the money options. But again, for the reasons that we just specified to you before, what you're much better off doing instead of buying that out of the money option is to buy that at the money option, because what it does is it gives you the best of both worlds. Because if the stock starts to move higher, that 205 option will become in the money, and that what that's going to do is that will decrease your time decay. As the stock goes in your favor, it becomes in the money, which decreases time decay. And what it does is, because of gamma, it's going to increase your delta. It's going to increase your leverage ratio. So as the stock keeps going higher and higher, you're going to get a higher and higher percentage of that move, because an at the money option, because in the money, and the higher, and the delta gets substantially higher while the time decay gets lower. So for those reasons, generally speaking, whenever you're buying an option, you want to buy at the money or slightly in the money options, which really provides you with the true benefit of both. Okay, does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Okay, perfect. Now let's talk about selling an option. So if we're selling the same expiration date, now if we're selling that expiration date, again, very counterintuitive in my opinion, because when you're selling, you want to sell something that's high, right? What's high? The 200 strikes, 12 crowns versus the 210 crowns, 210s, which only gets you about 6 crowns. But whenever we're selling, what you're going to know is that the 200 crowns has a lot of intrinsic value, which is not going to decay at all. So when you choose between, let's say, the 205 or 210s, which are both out of the money, what you're going to notice here is that the 205s, if you sold the 205s, the at the monies, what happens is that if the trade goes against you, that becomes in the money very quickly. And in the money options are not going to decay very quickly. So the 210s give you a bit of buffer here. So even if the stock declines by $5, I'm sorry, even if the stock increases by $5, which is not what you want when you're selling a call option, even if the stock increases by 5 crowns, you're still out of the money. And that means you're still going to have a high degree of time decay. Versus if you sold the 205s and the trade goes against you, then you're in the money and the trade starts to really start working. The time decay will stop being a factor that works in your favor. So that's why whenever you're selling option, very counterintuitive, selecting that out of the money option that actually has lower premiums will generate better results for you in the long run. So that's how you want to think about selecting expiration dates and strike prices. Like I said, both of these very counterintuitive when you're looking at a page like an options chain, because when you're looking at an option chain, when you're buying, you tend to gravitate towards smaller, shorter dated out of the money options, because these are cheapest. And you think to yourself, oh, if the stock just moves, 2% or 3% in my favor, I can make 100% return. That's the biggest fallacy of options trading is that you naturally gravitate towards those types of strategies, but those are the strategies that are actually worse for you. And vice versa, if you're selling an option, people tend to gravitate towards longer dated options that are near the current price of the stock, because they think, oh, I want to collect 9 crowns as opposed to 4 crowns. Who wouldn't want 9 crowns in income when you versus 4 crowns? But the answer is that I can get this 4 crown income in 8 days, and going out 36 days, I could have I could have repeated this trade maybe 3-4 times by that time that happens. So if I collect 4 crowns 4 times, that's a total of 16 crowns, which is substantially larger than the 8 crowns that I could have received if I only sold a single 36-day crown, a 36-day option. So it always adds up to more income for you in the long run by selling these really shorter dated options that seem like they have lower amounts of income, but what you're going to get is actually more income because you're able to do it more often. Okay, so I just want to make sure everyone understands that. Please type 5 into the chat window if that makes sense to you. And with that, what I'll do is I'll just start looking at some of the individual strategies that we might trade in our accounts and how this applies. So first, just a quick summary. When we're talking about expiration dates, when you're buying longer dated options, usually 1 month or greater for most buying strategies. Even if you only intend to hold on to a trade for a few days, you generally still want to buy a 1 month option. You don't want to just buy a 1 week option because you're thinking to yourself, I'm only going to hold on to it for a day or 2. If I give myself a week, that's more than enough time. You generally want to buy something at least 1 month or greater. Whenever you're selling an option, we said that we want to sell shorter dated options, but generally speaking, you don't want to sell anything greater than 45 days out. Anything more than 45 days out, you really can replicate that with multiple expirations of 3 to 3 weeks or so, and you're going to generate more income by selling 3-week options twice than anything around 45 days, okay? When you're talking about buying strike prices or any strike price, whether it's a single strategy, a single leg, or part of a broader strategy like a vertical spread or a butterfly or a condor, whenever you're buying an option, you want to buy an at the money strike or slightly in the money option, and then you want to sell an out of the money option, generally speaking, okay? So with that, let's take a look at some specific strategies. So talking about cover calls, this is the first strategy that you'll deploy as a first-time options trader. Now, how many of you have traded a cover call before in your portfolio? Please type yes into the chat window if you've traded a cover call before in your portfolio. Okay, I see quite a few yeses here already. So if you've sold a cover call before, you generally want to start 30 to 45 days out is a good starting point in terms of expiration dates. And you usually want to select a strike price that's relatively far out of the money. Now, far out of the money, we usually use delta to determine the strike price. Now, the reason we use delta is because, let's say I have a stock that's trading at 100 crowns, right? I can sell maybe a 105, a 110, and maybe let's say a 115, right? Those are my 3 choices as far as selling, let's say, a cover call. Now, the 105s are obviously 5% out of the money. These are obviously 10% out of the money, and these are obviously 15% out of the money. And many cover call traders, what they'll use is they'll use a percentage of the current stock price. Now, the problem with using a percentage like this is the fact that on some months, when things are quiet, a 5% move might be a pretty big move. But on other months, when maybe there's an earnings coming up, or maybe during the COVID-19 sell-off, a 10 or 15% move may be more normal, right? So this is really where, when you use a percentage for selling your strike price, when picking your strike prices, it doesn't account for the fact that some months are more volatile than others. So a couple of months ago in March, you would have had to adjust maybe to 15% rather than 5%. And there isn't a clear way to determine, well, is this month a volatile month, or is this month a somewhat volatile month, or a really volatile month? And that's really why whenever we're selecting strike prices, we never use a percentage to determine what strike price we want to use. Instead, what we use is delta. Now, what delta does is it takes into account the implied volatility of an option and basically gives you a probability of the stock being above that price by expiration. So when we look at probabilities here, this 105s may have something like a 35% probability, meaning there's a 35% chance that the stock will go from 100 to 105 or higher. The 110s may have something like a 20% probability, and then the 115s may have something like a 10% probability. So the further away the lower the probability. Now, the thing about these probability calculations is that they are constantly shifting. They're constantly shifting based on what the options are currently priced at. So what the option market does is it constantly reprices options based on new information. So for example, if COVID-19 news comes out, guess what? Option prices are naturally going to be more expensive, and these probabilities are going to change. And they're calculated in real time. So we always use a probability-based approach, and that's what delta is, so that no matter what happens, when things are more volatile, these will naturally get adjusted and we'll pick a different strike price. So what you want to do is you generally want to pick something in the 15 to 20 delta range, which means that you generally want to pick something that has about a 15 to 20% chance that the stock is going to be above that price by expiration. And when you use delta, delta will naturally select the strike price based on the current volatility. So when things are more volatile, it will naturally select a strike price that's further away. And then when things are not as volatile, it will naturally select a strike price that is closer to the current price. And what ends up happening is that you get a much more consistent process for selecting strike prices, because if you select based on probability, then you have a pretty good sense that at the end of the year, how many of your cover calls will get called away. If you use a 5% rule, then when things are quiet, things won't get called away. But when things are more volatile, a lot of stocks will get called away. And you don't want that inconsistency. And that's why it's so important to use delta when you're selecting strike prices. When you're selecting short puts, same thing on the expiration dates, 30 to 45 days away, but you want to select something that's significantly higher in probability. So on a 40 delta, it might be something like maybe 98 crowns, right? Something that has a high probability that the stock is going to be at that price or lower by the expiration date. So something like 98 may have maybe a 40% probability of expiring worthless. And that's exactly what delta tells us. So whenever we're selecting a short put, you actually want to select something that's still out of the money, but just slightly out of the money, because the thesis for a short put is very different. Generally speaking, with a covered call, you don't want your stock to get called away. But on a short put, you want to be put that stock. So that's why you have a difference in terms of selecting strike prices between cover calls and cash secured puts, okay? Does that make sense, everyone? Please type 6 into the chat window if this makes sense to you. Okay, perfect. See a lot of 6s. Now let's talk a little bit about directional strategies. So this is the most common option strategy if you're speculating. So if you think the stock's going to move significantly higher or significantly lower, you buy a call or a put. This is really where you generally want to start roughly from 45 to 60 days away as a starting point for expiration dates. So longer dated options, starting point. You could go further out in time if your outlook is longer than 45 days. But generally 40 to 60 days is a good starting point. Strike prices, just slightly in the money. So 50 to 60 delta, slightly in the money options. So if you have a stock that's currently trading at 100, you might select a strike price that's maybe either 100 or maybe even something like a 98 or so. 100 or maybe something around a 98. So slightly in the money option for a call option to bet on the stock moving higher. Now, a vertical debit spread. This is a strategy that we have spoken a lot on this educational course, because it's one of our strategies that we focus on quite a bit, because like I said, whenever you're buying an option, time decay is really working against you, right? So when we're thinking about buying an option to take a directional view, we always have to buy an option. But when you buy an option, you have time decay working against you. So one of the things that we utilize options for is that we can combine strategies together. We don't have to just buy options. We could also sell options at the same time. So a vertical debit spread really takes advantage of both sides to buy the option so that we have that directional convexity. We can bet on a directional view, but do so in a way with limited risk. But whenever we're buying an option, time decay is one of the biggest things working against us. So we can improve our odds of success by selling an option against the option that we purchased. In this particular case, we buy the 45 to 60 day at the money option or slightly in the money option, and then we sell a really far out of the money option. The same thing we do with cover calls. And the goal of this second leg is to simply let it expire worthless. And if it expires worthless, what happens is the premium that you receive on this offsets the premium that you pay for the long option. That reduces your risk, that reduces the time decay factor that you observe on the long leg. It reduces your break-even price because you're risking less capital, and it improves your probability of profit. So these are all the things why we utilize spreads very often in our trading, because it really marries both of what we learned here today between buying and selling options and gives us the benefit of both, right? This one has a much higher delta, which is why we were buying that option. We're selling this option that has very low delta, so that the delta becomes a very small factor in the trade. And most of what we're getting here is really offset for the time decay of the long leg, okay? So that is how we utilize directional strategies and how we select expiration dates and strike prices. Lastly, let's talk a little bit about selling strategies. So this is where we're predominantly selling. So a credit vertical spread is an example of this. So just like the other examples, whenever we're selling, we want to sell shorter dated options. So 30 to 45 days is a good starting point. Now, this is one of the few strategies where you want to sell an at the money option, because your primary leg here is selling and you have a directional view. To take on that directional view or take on the risk of that directional view of shorting an option, you need to be paid for that. And the at the money options pay you the most for that risk. But one of the things about selling an at the money option is that you have a lot of risk with those strategies because of the things I showed you before. An at the money option will quickly become an in the money option if it goes against you, which means that the time decay factor gets limited. You really have very little time decay once something is in the money. So to offset some of that, you can buy an out of the money option that offsets the unlimited risk factor. So when you buy an out of the money option, and this is really one of the few cases where you're buying an out of the money when you're buying an out of the money and you're selling the at the monies. Now, this is a strategy that, because of the unbalance, it is more difficult to trade. And this is why this is a more advanced strategy than the debit spread. The debit spread, in my opinion, is a little easier to understand. It takes advantages of all the things that we explained to you here today, versus selling a credit spread is really doing the opposite and trying to make the best of that. So that's why whenever you're selling a credit spread, it is, in my opinion, considered a more advanced strategy. It is not as optimal because you're buying an out of the money and you're selling the at the money, but it is used for very specific cases in terms of your market outlook. So there is a merit to this particular strategy, but it is a little difficult because it does not follow the most optimal selections for expiration dates and strike prices. So that's just a quick review of how you apply the things that we've learned here to specific strategies. So just a quick overview here. What you can do here is, what you'll realize here on options play is that we automatically apply what we just taught you on our screens. So for any strategy that you type in, any stock, ETF, or index, when you click on I'm bullish, we will always show you 3 bullish strategies: the stock leg, the call, and a call spread. We've automatically selected the expiration date. We've automatically selected strike price. This is already following the best practices that I just taught you here. So when we're buying an option, we're buying one that's roughly 51 days from expiration, the July expiration. We're buying the 1620 call on a stock, on an index that's currently trading at 1622. So an at the money, slightly in the money option. So this is how we go about selecting your starting points. And on the debit spread, we're also buying the July 1620, which is the at the money option, which costs 55 crowns. And then what we're doing is we're selling an option that's really far away. We're selling the option that's actually 1 standard deviation away. So roughly only about 15 or 16% chance that the stock or the index is going to be above 1760 by July expiration. And that collects 5 crowns here. So what it does is it offsets my cost of 55 crowns by 5 crowns. So what it reduces my cost from 5,500 crowns to just 5,000 crowns. And that small difference will go to provide a bigger return if you do get the directional move that you want. So if the stock moves up to 1750, rather the index moves up to 1750, here, because I've collected an extra 5 crowns, what it does is it increases my returns from 133% return with the call option to 157% return on the call spread. And I think that this maybe helps you better understand why the call spread here actually generates a higher return for your investment and reduces your risk by understanding a little bit about how they're constructed and why we construct it using this particular fashion. And you can use it for any stock or ETF. You can type in a symbol, either select I'm bullish and see 3 bullish strategies, or I'm bearish with 3 bearish strategies. We'll use the same methodology, select your put and put vertical strikes. And this is all designed to automate this so that you don't have to use pages like this every single time you want to place a trade to look through a page and decide your expiration dates and strike prices manually. You can click on any symbol. So let's say I'm looking at Axe Food. I can type in the symbol and immediately be able to select I'm bullish and look at 3 bullish strategies, or select I'm bearish and look at 3 bearish strategies very quickly, where you know the expiration dates and strike prices are already optimized. But this is designed to help you, this education session was designed to help you understand why we chose those specific expiration dates and strike prices, so that if you are choosing your own, when you're looking at an option chain, whether you're looking at the strategies, you know how to go about doing so. So with that, what I want to do is I want to thank everyone for taking the time out here this evening to participate. So many of you participated, which I really love, and I'm glad that you guys were able to do that. So with that, what I want to do is I want to, again, for you to access the tools that I just explained to you, you can access it using optionsplay.se, which I will post into the chat window for those of you that are first-time users to be able to access this. I think it's really important for those of you to be able to access the free platform, the free education, as well as the weekly cover call and short put reports that you can utilize for your trading. So with that, what I'll do is I'll open this up for Q&A. If anyone has any questions, feel free to type them into the chat window, and I'll sit here for a few minutes to try to answer some questions before I log off here today. Now, I see one question here from Shivrami. Can you show how to enter a pair strategy in Avanza or Nordnet? So unfortunately, let me see what I can do here. I will look at, I know I can take a look at Avanza's. Give me 1 second to pull that up. If anyone else has any questions, please type them into the chat window. I will say, generally speaking, I generally tell users that if you're trading an option and you're not sure how to enter an order, the best thing to do is to contact your broker. Your broker will be able to walk you through that and helping you understand how to go about doing that. Now, the question was, how do you enter a vertical spread, I believe. Now, unfortunately, I don't know how to go about doing this. It looks like you're going to have to log in order to do that. So unfortunately, I'm not going to be able to answer that question for you. I do recommend that you call your brokerage firm. They should be able to walk you through how to enter an options order for a multi-leg strategy, or pair strategy as you called it. Magnus is a great presentation. How can I see the delta in options play? Really good question. So you can click on the blue button on any strategy, and at the bottom we have a button that says explain strategy in Greeks. So what you can see is the delta, the theta, the gamma, and the vega. The two that are most important, in my opinion, are delta and theta, which is why we have an English explanation for it. So basically telling you for every crown that the Axe Food decreases by with this put option will result in a 55 crown profit. But due to time decay, you'll lose roughly 8 crowns a day to time decay as expiration approaches. So, you know, it's really, this is really designed to help you better understand the Greeks. And this is all designed to help make your experience a little easier. Wolfgang, if you don't mind sending me an email at info@optionsplay.com and just tell me what you see, and I'll be happy to give you a better understanding as to how to access that. Galaxy A3, which I'm guessing is the model of your phone, you're asking for neutral strategies. So credit spreads is really a neutral strategy, right? So this is a strategy that we generally consider neutral. So Axfood, I actually think, is a pretty good example here where instead of just buying a put option, you might want to consider selling a call spread, which is more of a neutral strategy. So selling call spreads, I would choose a shorter dated option. Generally speaking, you want to sell an at the money option, so about 200 or 205. So something like this is suitable for a neutral strategy, selling a credit spread. A credit spread is a neutral strategy. So even if the stock stays exactly where it is, meaning at expiration by June 18th, it's at at 201.60. Here you make 190 crown profit as a neutral strategy here. So selling options is the neutral strategy here. Tomas is asking, if I have sold a naked call option, for example, strike 120, and the stock is already at 140, what is the best strategy to repair that position? If there is any, except selling at a loss. So Tomas, there's one thing, I wouldn't necessarily say it's a repair strategy, but what you can do is you can buy a call option that prevents you from losing any more if the stock continues to move higher. That's basically turning your naked call, in this particular case, your naked call into a call spread, as I just explained it. That is one way to contain the losses. But I will say that if you sold a call option at 120 and the stock's already at 140, that means that your original trade was just simply wrong. And as a market strategist working with customers over the last 13 years, one of the most important lessons that I think many traders fail to learn or struggle to learn is learning to take a loss and moving on to the next trade. What I find too many traders do is they focus so much on winning each individual trade that they forget that they're blowing up their entire accounts just to win at every single trade. And that's sort of ironic that you lose because you focus too much on winning. But this is really the thing that I taught in part 1 of our beginners course 2 weeks ago, and I highly recommend you to take a look at that recording. I'll post the link to everyone here in the chat window here in 1 second. But the importance in learning to take a loss and move on to your next trade is one of those most important things that I think a trader or investor needs to learn before they can succeed at trading, is not thinking about winning each individual trade, but thinking about your portfolio and thinking about how do you grow your portfolio? How do you prevent your portfolio from blowing up? And the answer to your question is really there's nothing to do to repair your trade without adding on more risk. And you should never add on to a losing trade just so that you don't have to lose. Because that's really where many times you see traders get into a lot of trouble is they have a losing trade, they try to do something to fix that losing trade, and next thing you know, you've lost more money. And sometimes that can compound on itself, losing even more and more money over and over again. I've seen it too many times as a strategist, and that's part of why I find it so important to teach that as a lesson. Yes, there are some strategies that you can repair, but many strategies, I generally find it's best just to take your losses and move on. I just posted the link to you in the chat window for how to access the last recording that we just did last week on trading psychology and how important it is for success in trading. So I hope that that was a long but meaningful answer to your question, Tomas. Can you please make a playlist as the videos aren't in the right order to follow? We actually have a whole education page, so and they all are in order. So I will post the link to you in the education page. So we have our webinar recordings all available to you here, and they are in order. So I posted the link here in the chat window so that you can watch them in order. Jonas is asking, are there a possibility of graphs of implied volatility over time? That is something that we are looking into. I currently do not have access to historical implied volatility for the Nordics. So unfortunately, we don't have that data at the moment. It is something that we can consider looking into, but unfortunately at the moment, I don't have a data source for that. Any other questions before I sign off here for today? And again, thank you so much, everyone, for joining this evening. We do have an education event coming up on June 3rd. So we will be sending out an email for everyone here in the next day or two. So that look out for that. It'll be a great options education day. Me and multiple Swedish speakers will be talking together, so you get back-to-back sessions. You'll cover a large number of topics within just a couple of hours of time. I'll be talking about generating income using options, and I'm really excited to be doing that. We'll be joined by quite a few speakers. Most of them will be in Swedish, but I will obviously be presenting in English. But it is all going to be focused predominantly around options and making sure that you guys understand how to utilize options. They're all professionals showing you how they utilize options in their portfolios. So really excited to be doing that here on June 3rd. So that's coming up very shortly, just next week. Really looking forward to many of you joining us. We've hosted events like this in other countries before with a lot of success. So I'm really looking forward to be able to giving you guys a very rich options education experience coming up next week. So please look out for that email coming to you in the next day or two. With that, I want to thank everyone for taking the time out here this evening. Thank you so much for participating. Everyone that answered your questions, answered my questions during the session. That was fantastic. You know, this is really the best way, in my opinion, to learn is to come live, participate, being able to answer your questions live. This is how you can continuously improve your options education. So please utilize the tools that are available to you, the platform, the webinar recordings, these live sessions. These are all designed for you guys to give you a better understanding of how to trade options. So thank you so much. I hope you guys have a great evening. We will send out the recording with the slides to you later this evening or tomorrow morning at the very latest. But we will make sure that you guys have the recording and update the education page so that you can just visit the education page and everything is available to you there. So please have a great evening, stay safe, and I'll see you guys next week.